Welcome to The Explainer. Today we're digging into a really fascinating story, MediAssist Healthcare. How does a company that looks like a rock star performer suddenly see its financials get turned completely on their head in just 6 months? Well, we're going to find out by looking right at the source, their investor calls.
So check this out. Just 6 months ago, MediAssist looked like it was in incredible shape. You're talking about a super healthy 21.3% EBITDA margin, a key way to measure how profitable a company is. They had zero debt, and on top of that, more than 300 crores sitting in the bank. Profits were even growing at almost 30% year over year. But fast forward to today, it's like a totally different company. Now they're saddled with over 240 crores in debt. The margin has shrunk down to 17.1%, and that profit growth? Gone. It's actually cratered by more than 60%.
You just don't see turnarounds this sharp, this quick, very often. It's pretty dramatic. So you have to ask, right? What on earth happened here? Well, let's dig into the one big thing that kicked off this whole chain of events. So here's how we're going to break it down. First, we'll look at the big acquisition that started it all. Then, we'll dive into the tough questions analysts were asking the management. After that, we'll try to read between the lines of their answers, see what they're really saying. And finally, we'll lay out their comeback plan and figure out what this all means if you're an investor.
Okay, so this whole story, it really all comes down to one single massive strategic decision. A decision that's given the company, let's call it a calculated but very, very painful financial hangover.
So, what did they do? They went out and bought Paramount, a huge competitor in the third-party administrator space, the TPA industry. And boom, just like that, their market share shot up. This move made them an even bigger fish in the pond. The problem is that dominance came with a really big price tag, and it immediately messed up their once perfect financials.
So that drop in their profit margin, it wasn't just one single thing. Management actually laid it out pretty clearly for the analysts. They said, look, about 1.5% of that drop came straight from trying to absorb Paramount, which, by the way, was a much less profitable business. And then another 1% hit came from spending on their own new tech. But, the hit to their actual profit, the bottom line, was way, way worse. When you add up the cost to borrow money for the deal, plus those lower margins, their net profit just fell off a cliff. We're talking a staggering 61.5% drop compared to the same time last year. Ouch. Now here's a really crucial point. A huge piece of this profit drop isn't actually cash walking out the door. It's kind of like an accounting thing. See, when you buy another company, you're not just buying buildings and computers, you're buying things you can't touch, like their customer list. That's called an intangible asset. And accounting rules say you have to slowly reduce the value of that asset on your books over time. For MediAssist, that's a 3.5 crore rupee charge every single quarter. It's not real money being spent, but it sure makes the final profit number look a lot smaller.
So you can probably guess what happened next, right? With numbers this wild, the financial analysts on the earnings call had some, let's just say, very pointed questions. They were really trying to figure out if this was a small fire or a full-blown inferno.
All right, first up, they went straight for the balance sheet. An analyst named Madhukar Ladha from Nuvama pointed out that something called trade receivables, that's basically the money other people owed to the company, had shot up. The big question was, hey, are you guys suddenly having trouble getting paid?
The CEO, Satish Gadugu, kind of waved it off as a temporary thing. He said, look, it was just a small timing issue with collecting payments from a couple of big clients. It's already been sorted out and we're back to normal now.
But they didn't stop there. Next, another analyst, Jayesh Gandhi, tried to get to the heart of the matter. He basically asked, okay, let's talk about Paramount. Just how profitable is this business you bought? I'm guessing it's actually losing money. Can you tell me how much? He went right for it.
And this is where the answers started to get a little fuzzy. Management pretty much dodged the question. They wouldn't give a specific number, saying they don't break out the results for companies they buy. All they would say is that Paramount brings in very low profitability EBITDA. But how low is very low? They wouldn't say.
When you listen to these calls, sometimes it's what's not said that's the most important thing. And for analysts, that kind of reluctance to give a straight answer, that can be a major red flag.
So let's try to read between the lines here. That timing issue with collections, maybe it's a way of downplaying a real problem with getting paid by some of Paramount's old clients. And refusing to put a number on Paramount's low profit, well, that strongly suggests the number is probably negative and they just don't want to say it out loud. And by lumping all the costs together, it makes it really hard for anyone on the outside to figure out what's a temporary headache from the merger and what's a permanent, painful problem with the business they just bought.
Okay, so they took some heat from the analysts. The big question is, what's the plan? How are they going to fix this mess and get the company back to where it was?
Well, to their credit, they did lay out a pretty clear roadmap. The CEO basically said, give us about a year, maybe a little more, 4 or 5 quarters to sort this out. The plan has a few steps. First, just stabilize things at Paramount so customers don't run for the hills. Second, move them over to MediAssist's own, much better tech platform. Third, find ways to cut costs and be more efficient. And the end goal, get the whole company's profit margin back up to that healthy 22 to 23% level.
And it's not all just about damage control with Paramount. They made it clear they're also looking to the future. They've got a few things going on. They're selling their own tech platform to other insurance companies, which is a great high-margin business. They're also breaking out some of their services, like fraud detection, and selling them on their own. Plus, they're growing their international business. And importantly, they made a promise to pay off all the debt from this deal by early 2026.
So, where does this leave us? It all boils down to the classic investor dilemma. You've got a high-risk, high-reward situation on your hands, and there are really 2 completely different ways you can look at this whole thing. Okay, so let's break down the 2 sides. On one hand, you have the believers, the bull case. They'd say this was a brilliant strategic move. Yeah, it hurts now, but they took out a competitor and grabbed a huge chunk of the market. And in this business, size is everything. It gives you more power when negotiating with hospitals. So the believers see this as the foundation for long-term dominance. Then you have the skeptics, the bear case. They're saying, whoa, hold on. You guys overpaid for a crummy business, took on a mountain of debt, and now you have to pull off a perfect turnaround. They'd argue that those vague answers from management are a sign that there are bigger problems lurking under the surface that could sink the whole plan. So, in the end, management made a huge gamble. They chose market share and long-term power over pretty profits today. Was it a masterstroke or a massive misstep? Honestly, we're not going to know for sure for another year or so, but it's definitely going to be a fascinating story to watch unfold. That's all we have for this explainer.